Alrighty guys, what is going up? I hope you guys are all having a great and amazing day today. Now in today's episode, we're going to be talking about, is the stock market going to crash in 2021? So I hope you guys enjoy it, and if you guys got anything in value, hit that like button and subscribe, because it really helps me out when you guys do that. And if you guys want to learn more about investing in the stock market, go ahead and check out my course. It's free for only 3 more days. So make sure you guys sign up. It's the Black Friday sale. Sign up. It's literally free. You just got to put in your email. So now let's jump into it. Roll that intro. Let's go. Bam. A lot of experts right now are saying that in 2021 we are going to have another stock market crash. We're going to have a terrible recession. We're going to go back in the Great Depression, and you should be terrified. Guys, that's not going to happen. Yes, we have some circumstances that is a little unusual, but at the end of the day, no matter when you invest in the stock market, if you're a long-term holder, you're fine. If you can follow the simple step, buy, hold, and repeat, you will be wealthy if you invest in just the S&P 500. So no matter when you buy, you will be successful. It's not about timing the market, it's about time in the market, because at the end of the day, that's all that matters. So now the first thing I want to get off my chest is, when you are an investor in the stock market, no matter what the stock market is doing, so if let's say in 2021 we have another crash, because I think in 2021 we could possibly have a correction, not a crash. A correction is pretty much when the stock market sells off, maybe 5-6%, and then rebounds the following year. On average, it does do that about once a year, so it's very common to get some sell-off when stocks either become overvalued or when we just have a very long bull market for that year. So it's super common to get sell-off. So at the end of the day, you don't lose money unless you sell your stock. So like I was saying, if you are a long-term holder, you're not going to lose any money. If anything, what you should do is look at this as an opportunity to buy more. Now imagine you guys were saving up to buy a candy bar, and if let's say that candy bar consecutively went up from $1 to $2 and then $3, and then all of a sudden it sold back off to $1, you would buy that candy bar at $1. The stock market's the same thing. You have to look at sell-offs as an opportunity to buy more for the S&P 500 or really any of the indexes. The second thing you guys need to understand is that 96% of hedge fund managers lose money. And I know a lot of you might be saying, well, Carter, why wouldn't they just invest in the S&P 500 then? Well, because there's money to be made in these hedge funds. They charge fees, they charge commissions, so they're making money no matter if the stock market's going up or down or just consolidating. So if you can't beat the market, you might as well be in the market. So don't listen to any of these hedge fund managers. If you guys are just long-term investors, like I'm saying, you'll be fine. Now, of that 4% that actually correctly beats the S&P 500, 2% don't beat it the following year, and the other 2% you have to have a net worth of over $5 million just to even talk to these guys. So it's always smart just to be in the S&P 500. You'll be fine, I promise. So now the third thing I want to talk to you guys about is, over the course of the S&P 500, the past 90 years, the S&P 500 has gone up 9.6%. So no matter when you invest, you're profitable. So if you invest at highs, at lows, or at middle ground, you're gonna be just fine if you're holding for the long term. A lot of people love to try to time the market. It's a terrible thing to do. You're not trading or investing in the stock market. I think that as long as you guys don't check the day-to-day price, you guys will be just fine. So now the fourth thing I want to talk to you guys about is, don't try to day trade or swing trade the market. It's extremely difficult, and at the end of the day, you will probably lose money. If you're not experienced or if you're just uneducated on it, it's going to be a big learning curve, because swing trading is a craft, it's a skill, and you have to practice before you even try it. Now, and if you're interested in trying it, I believe you guys should have education. You guys should open up a simulated trading account and just try, practice, because it's extremely hard. Now, a lot of people just have this mindset that investing in the stock market is an easy get rich quick, and at the end of the day, it requires skill. So if you have practice or a strategy that works, then you will be fine, but it's developing those skills that takes time and money. Now, and for a lot of you guys, it may be just easier to invest for the long term. So now another thing, of the day trading community, 86% of the people who try fail, and there's only like a 14% success rate. So don't listen to all the traders out there. You guys are long-term investors and it'll be all right. So now a lot of people always like to ask me, Carter, what is the best strategy for investing for the long term in the stock market? Well, here's the thing. I'm a huge dollar cost averaging fanatic. The reason why I'm a huge believer in this is because it reduces your risk, it reduces volatility, and you don't need $10,000 or $1,000 or $100,000 to invest. You can invest, for $10 or even $100 a week over the course of 40 years adds up to millions of dollars by the time you retire. And the people who have such a huge advantage with dollar cost averaging is younger people. If you're 18 years old, you can invest literally like $50 a week and retire a multi-millionaire. And if you have a Roth IRA account, you won't have to pay any taxes. So it's like a huge incentive for people to invest, and they think they need so much money when they don't. But how dollar cost averaging works is you pretty much pick the ETFs or even some stocks. So really automatically I invest 40% of my money into the S&P 500. The S&P 500, 9.6% every year, automatic dividend reinvestment, super simple, never have to worry about it. So then after that, I do take around 10 to 15% of my money and automatically invest in VIG. This is Vanguard's High Dividend Appreciation ETF. This is a huge dividend cash flow king that I can rely on dividends coming in that I can use to either invest in other things, or I can just automatically reinvest it right back into that ETF. And that's what I do. Then after I do that, I automatically invest 10% into the bond market. Carter, why do you invest in the bond market? Bonds don't make any money. Not true. I get a 5% return and I get a 3.5% dividend every single year. So that's pretty decent. And I use the bonds almost as like a holding of cash. So when the stock market falls extremely undervalued like it did in March, I sell all my bonds and I put it right into the S&P 500 because I know the S&P 500 isn't going anywhere. And when it sells off, it's a huge opportunity to buy more. And it's a huge advantage because I have all this stored cash that's paying me cash flow and growing. So I use that bonds as almost like a cash. So then with the rest of my money, I invest into high growth blue chip stocks that pay me dividends. These are going to be companies like Home Depot, Apple, Costco, Lowe's, Coca-Cola, companies that I don't have to check the day-to-day price. We all use, and they have a perfect cash flow, great balance sheet, and it's just a win-win. And the thing about this is you can easily set this up with M1 Finance. That's why I like to use them, but I'll put a link down below so you guys can get 10 bucks. But I'm not getting sponsored or anything like that from them. And another thing, if you guys are going to invest into high growth stocks that carry a lot of risk, these are going to be companies like Neo. These are going to be companies that are in some low startup tech. These are going to be marijuana or cannabis stocks. These are going to be companies like Blink Power, Workhorse, companies that, have a lot of long-term potential, but they also carry a lot of risk. Then what I do is I honestly make sure I have enough bonds to kind of outweigh those stocks, and I never invest more than like 1 to 2% of my money in them because it's just not a good investment for me. I would rather have those high risk stocks, maybe let's just say 2 of them grow to become very, very successful. That outweighs all the losses of all the other stocks. But me personally, I don't think that the stock market is going to fall off by next year. I don't think you guys should even be worried about it at all. I think that if you guys are long-term investors, don't even worry. Honestly, if it does, look at it as an opportunity to invest more. But I hope you guys enjoyed the episode, and if you did, hit that like button and subscribe to the channel. And guess what, guys? I shaved. I look a little different, huh? All right, we'll see you guys tomorrow. I hope you guys enjoyed it. Remember to stay happy, stay positive, and stay safe out there. We'll see you tomorrow. Bam!